I've learned this lesson relatively young in life, so I'm thankful for that. But I've learned how quickly things can go south in real estate when one party kind of goes rogue.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 192. My guest today is an 11-year real estate veteran out of Canada. He's an author, cable TV host, and podcast host. In fact, I was just featured as a guest on his podcast show, Purchase to Profits, which is available on iTunes and YouTube. Seth Ferguson is also an award-winning real estate broker who not only helps clients buy and sell homes, he helps them build their real estate investment portfolios. And he's got an interesting story that he's going to share about his real estate investment portfolio that he built in Toronto and what happened there and where he's going after a pretty big setback. So Seth, I can't wait to get into this conversation. Thanks so much for being on the show today.
It's my pleasure. Thanks for having me.
I know you're up in Canada, so you can tell us a little bit about investing in Canada, what that's like. But, I always start the show with tell us a little bit about yourself. Why don't you share some of the details?
Well, I enjoy real estate investing on my, on my dog sled, going to Tim Hortons and getting a double-double, and walking around in snowshoes. So
that's exactly how I picture you.
Yeah, that's right. With myself, I started off in real estate 11 years ago selling the product. So I was a real estate broker. I still have my license. Then I got into the investing side. And the reason I got into real estate in the first place was I was trying to make the NHL as a hockey referee. My playing career didn't go as planned, so I took refereeing pretty seriously. I did some pro leagues and some really good junior leagues, and that didn't work out. But real estate offered some schedule flexibility, so I could still do the games and make a living. Got into the single family investing because that's what I knew. That was the product I was selling, and I'll share all the juicy stuff for later on in the conversation.
Yeah, well, let's talk about that. So you got into real estate because it was something you could do on the side while you were refereeing. What kind of portfolio were you building, and where were you purchasing? Yeah,
so it was located in the Greater Toronto area. So Toronto is, it's kind of like a New York. It's pretty big. So I was building in a town called Milton, which is almost like a bedroom community on the outside. So it was basically single families, did a duplex conversion, and then we had a property in Brantford. So things were going really well, building up. It was a product that I knew really well. I knew the area, lots of strong key market drivers, tons of growth. About 150,000 people move into the area every year. So really strong population growth there. So we were building up, and I think if I could go back in time, I'd do things a lot differently. The one thing I found building up with single family homes is you hit a wall at some point with how much money the bank will lend you, especially in the Toronto market is not a cash flow market. The prices, the average house price, in the past couple months is around $850,000. You compare that to some cash flow markets, especially in the United States, the numbers look a lot differently as you're building up. So it's a different strategy. You have to think about it. The 1% rule goes out the window really quick. 2% rule is like a unicorn. There's no way that's going to happen.
Well, what is the strategy there? If you're not buying for cash flow, where are you making your money? Are you just counting on appreciation?
Yeah, you have to be really smart with the properties you do buy. Especially, so I'll give you an example. So Milton, 20 years ago, it was 30,000 people population. Now we're about 115,000. And, by the year 2041, we'll be around 300,000 people. So getting into the right markets where you're going to have that crunch and that influx of population, you want to purchase along the path of progress. And so a lot of people stay away from the negative gearing. That's actually a strategy that has been employed successfully here.
Well,
however,
you use a term, negative gearing. What is that?
Yeah, so negative gearing is in a perfect world, your real estate portfolio or every property will produce positive cash flow after you pay your management, after you pay your taxes, after you pay all the maintenance, all that stuff. In a market like Toronto or Vancouver, if we're going to use another Canadian example, or even markets in California, New York, when you purchase a property, the purchase price you're paying and the rent you're getting, it doesn't balance out. You're going to have a monthly loss, and that's where you're negatively geared because it's actually eating in. You're actually paying to own the property.
So negative gearing is a euphemism for losing money.
Exactly. And so you have to be very strategic. I always tried to have the property break even. So as long as I was kind of treading water, being neutral, I didn't really care if I was making or losing money because I was kind of in it for the long game. Actually, on my show, I had a very interesting guest, Chris Gray from Australia, on, and he used that strategy because the Australians, for some reason, think that they should rent a house and take a loss because they're giving the rents there are way less than what they should be because it's almost like, oh, well, you're renting, so you should get a great discount. So it's a different philosophy.
So the landlords see it as a social good. They're offering a social service, and they're willing to take a loss just for that.
Yeah, it's really odd. But that's so. Chris and I spoke at length about how you build a portfolio in that sort of environment. So really interesting conversation there. So, you always have to be very careful. In the Canadian market, we had a pretty sizable correction in the spring of 2017, and a lot of people got burned because they were not being prudent and making wise choices. So if somebody's looking at investing in a non-cash flow market, so a major metropolis, anywhere really, I wouldn't recommend purchasing a property that would be negatively geared right off the bat. This is more for somebody who is very familiar with the market, has a number of properties under their belt, and they're really experienced and have a pretty solid idea of what they're doing and what to expect in terms of doing that. I'm probably going to get crucified by a bunch of real estate investors who swear by the 2% rule and swear by the 1% rule. But you really have to take a look at the market you have and what you're given to play with, and you have to adapt according to the market.
The strategy that you're employing with the negative gearing, I've seen that employed many times. When I lived in Los Angeles, people were buying rental property at negative cash flow. Yeah. But the appreciation was so strong that they were making money hand over fist because they'd sell in a year and they'd make hundreds of thousands of dollars. Now, I want to see if that's what you're doing. But the risk there, of course, is that when the market turns, then they lose a lot of money because they're not only are they negative cash flow, but they're also upside down on their property. So I want to know how you are employing negative gearing to make money and how you're also mitigating for that risk.
Yeah. Well, like I said, my goal is always to come out treading water. So if I break even, I'm a happy camper. One example, so we had a condo. And on the surface, the condo, it was losing money every month. But then we were able to acquire a second parking spot in a building where parking was at a premium. So we were able to rent that parking spot for $210 a month. So all of a sudden we go from losing money to treading water. And I know over the next 10 years as Milton or the area doubles, triples in size, it's a pretty strong there's always the double-edged sword of investing in speculation. And negative gearing, I guess you could classify it more on the speculation side, but you always have to go back to the key market drivers that are going to drive that real estate market. So if you have very solid job growth, ridiculous population influx, I would say it's a pretty safe assumption that you're going to experience some tremendous growth in that market.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. I know that you were investing in single family and duplexes in the Toronto area. And Milton, is it?
Yeah, Milton's one of the towns. That's where I grew up.
Okay. Yeah. And is that just like a suburb of Toronto?
Yeah, it's a suburb. We're about 115,000 people now.
So that was your strategy. Tell us how you built that portfolio and then kind of what happened.
Yeah, so things were going really well. It was myself and my partner at the time. And, like I said, we were experiencing the lending crunch as most single family investors experience. There comes a point where, banks don't want to lend you any money because you don't fit into their box that they like to. What
is that? What is that point in Canada? I know in America, when you get between 6 to 10 single family or residential type loans, the banks want to stop lending to you at that point.
Yeah, it's very similar here. The big difference in the Canadian lending environment right now is very, very tight. There was something introduced a couple of years ago called the stress test, where you actually have to qualify for the mortgage at a number of interest points higher than what you'll actually be paying. So it's almost like, okay, well, you're going to get a mortgage at X percent, but just to make things difficult and make sure things are more stable in case interest rates do rise, you'll have to qualify at 2 percentage points higher.
Why is that? So are you able to get fixed term, like 30-year amortized loans, or do you have to refinance every 5 years?
Yeah, so in Canada, this is actually really interesting to see how two very similar countries diverge. So in the late 1800s, I think it was, there was something called the Interest Act that was introduced in Canada that said that if you have a loan from a bank or a mortgage, you could pay it off after 5 years without any penalty. So of course, all the Canadian banks ended up saying, listen, we're just going to keep the balloon payment after 5 years. We'll amortize it over 25, 30 years, but you'll have to pay up and refinance and get a new mortgage every 5 years. So in the States, this is a lot different. I would love to be able to lock in, the interest rates we are experiencing now for the next 30 years. But in Canada, the system's a little bit different. So you've got that balloon payment, let's say every 3 to 5 years.
Wow. So this is a huge difference, because on residential property, one of the strategies for a lot of buy and hold real estate investors is to lock in 30-year, 20, starting at 15, you can get 15, 20, 25, 30-year fixed interest rate loans. And you're telling me in Canada, which is right next door, every 5 years you have to refinance?
Yeah, and I find it fascinating how the two systems diverged at that point. But it all goes back to the Interest Act. I forget what year. It was like the late 1800s. But very recently, the governor of the Bank of Canada, he, in one of his addresses, he made comments about how he wished there was more creativity and more flexibility. And he made an argument that, having longer terms on the mortgage would actually make the system more stable, because instead of having, let's say, a quarter of people refinancing every year, that makes the whole mortgage sector very susceptible to big shifts. But if you only have a tenth of the people refinancing every year because they have longer terms, it can stabilize it. So lots of very interesting theory on which way is better. But I would say, though, being able to do a refi, let's say every 3 years, if you're on that upswing in the market cycle, if you're in that boom period, starting the boom period, having that refi after year 3, you can pull and access a lot of equity, and then use that to take down the next property.
Wow. So I see the benefits to investors, but to the average consumer, what the minister or whoever said that is right, because what you're doing is you're exposing everybody who owns a home to interest rate risk and economic risk, economic cycle risk. Yeah. Every 5 years. And that's, I think a lot of people weathered our last great recession in 2008 through 2011 because they had a fixed rate loan that didn't come due. Wow, that's a recipe for disaster.
Yeah, it's very interesting. But then you look at it. So in 2008, so we had the global financial crisis. When you look at Canadian real estate versus the American real estate market, the Canadian real estate market was a lot more stable. So there's pros and cons to both systems, and I think we need about a 5-year college course to go through it all. But,
we could just have a conversation about this all day. It's fascinating. But I want to talk about your portfolio, because you built this with a partner. Tell us what happened there. Like how many units did you get up to, and where did things? Because I know things turned south on you. At what point did that happen?
So it was about a year ago. Things turned south, and this was not only a business partnership, but this was a personal relationship as well. And I think this was a lesson I learned. So right now I'm 32 right now. So I've learned this lesson relatively young in life. So I'm thankful for that. But I've learned how quickly things can go south in real estate when one party kind of goes rogue. So basically what happened was there were challenges in the relationship. The relationship ended, and then as a means of, I guess, payback, one of the parties kind of took the portfolio and blew it up, and wiped out the bank accounts, changed the locks on the house, and stopped paying all the bills. And with the single family portfolio, and this is one of the, I would say, disadvantages of owning all single family homes, is when a tenant moves out, your cash flow stops. So in a situation like this where the bank accounts are wiped out, so let's say you'll let's just say it was a lot of money that disappeared overnight. So when all the money goes away, and then you have vacancies now because tenants are moving out, and then the other party won't sign any leases to put people back in, you can see how it snowballs, because now you have all these vacancies that nobody can move in because you need both signatures because you're both on title. And so it blows up from there, and it gets ugly pretty fast.
Wow. Okay. So
but worst case scenario, I would say, in every respect.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional healthcare insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage, or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. First of all, I appreciate your silver lining you're able to pull out of that, which is you're only 32, so you've learned your lesson early. That's
I call it my $300,000 mistake.
Oh, Now, my interpretation of that is that you were in a relationship and you were investing together. And when the relationship ended, the other party got vindictive and decided, well, not only are we going to end this relationship, but I'm going to destroy you in the process.
Pretty much. We can say I found my clothes in a storage unit with garbage. So.
At least they were in a storage unit, huh?
Yeah. It's just too bad. Like all my suits were cut up with scissors, but
were they really?
Oh yeah. So yeah, we can go on forever about that, but we'll keep it to real estate.
Well, okay, but let's use this opportunity to talk about getting in partnerships with the wrong person. So feel free to not answer this question, but what were the red flags that you should have noticed early on?
Ooh, we can go red flags from a business perspective or from a personal level.
I mean, it's both really. In business, you got to look at all the whole picture. So where should you have realized early on that, okay, this is a person who would ultimately be this vindictive and do these types of things?
Yeah, I think that the thing with hindsight, it's always 20/20. So, and I kick myself for not, because looking back, there were red flags almost immediately. But when you first, you fall in love, everything's rosy. As a red-blooded male, you think with a different body part other than your brain at times, and you just don't see those warning signs. I think. In the future, because now, I'm rebuilding, I'm back on my feet. So I'm looking at new partners to go into a real estate venture. And I think, personality has a lot to do with it. There were some things that were not right from a mental stability standpoint with my past partner. And, just looking out for wild swings of emotion. You're happy one second, then you're in despair the next second, and you're always on a roller coaster. It's almost like you're standing on sand and you're not sure where the sand's moving, like when the water goes out on the beach. So you're always trying to find your balance. And also just having a very realistic conversation, expectation on what your goals are, where you want to end up. For me, we had a son together, and, I remember holding my son for the first time, and I experienced almost an instantaneous feeling of needing to do more and needing to be better for my son. Before I was in real estate because for myself, but all of a sudden you're holding your child and it's like, well, this isn't about me anymore. This is about him. So I had an urge to scale, to do more, to be better so I could leave something and have a legacy and make sure he's protected. The partner at the time, I guess you could say, even though we were purchasing real estate together, I don't think the understanding or the drive or the ambition in building something really special was there. Whereas me, I wanted to build a portfolio that would leave a lasting legacy and have a big impact. So whenever I'm speaking with partners now, we have an open discussion about skeletons in the closet, which is always an interesting conversation because everybody has skeletons. Always talk about where they want to be in 10 years, where they want to be in 20 years, and see if that aligns, because not everybody's goals are the same. Like my goal is in the next 10 years, I want to hit $1 billion of assets under management. Somebody might be happy owning a couple triplexes, and that's totally cool. But if you're going to partner up, you need to be on the same path. And I also like to talk to people about their weaknesses and their strengths. I've learned from doing all the interviews on my show, and I'm sure you found the same thing, is the really successful partnerships, it's almost like a puzzle. You have strengths and weaknesses on both sides, or on all three sides, depending on how many partners you have. And it's all about putting things together in a way where you're mitigating the weaknesses, but really emphasizing the strengths. And that's really something I'm looking out for now as well, because I've got some strengths, but I also have a lot of weaknesses, like everybody else. So I want somebody who's able to complement that and actually build. It's almost like when you have two people that partner up that are a good fit, it's not 1 + 1 = 2. It's 1 + 1 = 10.
How do you prevent this from happening again? Because it sounds like your financial accounts, and especially the real estate accounts, were commingled with this other person. Here in the United States, I don't know if you have like limited liability companies where you can kind of segregate your business from your personal. How do you prevent this type of intrusion from happening again?
Yeah, I think the number one thing is require 2 signatures on every joint account so somebody can't remove a lot of money without you knowing about it. I think that would be one thing. You mentioned the LLCs. You have to be Canadian financing. A lot of the major banks don't like lending to a corporation. We don't have an LLC per se, but we do have some structures that are similar. And in terms of the single family investing, you're most likely going to get better terms if you have it under your own name and not under a company, and which is an awesome advantage of going with the larger multifamily properties, because that totally shifts the game, and that's where I'm focusing now. But I think in the future, just having those checks and balances where you need, going to see a lawyer before you even buy your first property, even if it's with the spouse, because you have no idea what's going to happen down the road. So have shotgun clauses. If X happens and you have X amount of vacancy and one person's refusing, it's either an automatic buyout, or it's you have all these contingencies in the agreement that we didn't even have an agreement on paper. We were just, we were together, we have a child, we own all this real estate. Things seem pretty good until, things aren't good.
Mm-hmm. Yeah, absolutely. Yeah. What's your recourse then when this happens?
You go through what is called the divorce machine. And it is a very long process and an expensive process. And, even though there's a chance to get your money back, you're not going to get your money back because it's all going to go to the lawyers.
Mm-hmm. And what happened to the properties? Did they end up going back to the banks? Or
well, I'm still in the process of extricating myself from it. So a number have been sold. There's still a couple remaining, and that's to be determined. But I think in terms of how things are going, they'll have to be sold off, and you just start again.
Wow, that's awful. I'm sorry that happened to you, but thanks for sharing it with us.
Yeah, hey, if somebody can learn something from that, that's all that it's about. You have to go into these relationships, even though it's with a spouse or a trusted partner. Talk to a lawyer first. Find out what can actually happen. Worst case scenario. Chances are, worst case scenario like this will not happen, but it's not lightning strike, right? That's why when you're on the golf course, you go back in the clubhouse when there's a thunderstorm. Chances are you won't get hit, but it's that one time that it does, it'll really wreck your day.
Yeah, absolutely. So how do you rebuild from that? Because it sounds like you have a bigger vision. You're going to build a new portfolio, bigger and better, and billions of dollars of worth. How do you start from where you are and go down that new road?
Yeah, I would say the one thing she wasn't able to take from me was my experience. 11 years in real estate, you learn a lot in 11 years, especially in a very interesting, active market that, I started off selling in, then that I was investing in. You learn a lot of very valuable lessons. And I think that's the biggest strength I have going forward is, sure, I lost a lot of money and lost a lot of other things. But the experience will always be there. And, I have a tremendous advantage because lots of people are getting into real estate now. They have, a couple of years experience. I've got over a decade now. So I think that's an advantage for me. And so right now I'm shifting. And, I mentioned before that I wish I did things differently at the start. if I could go back in time and have a conversation with myself, I would most likely steer myself away from building a single family portfolio and concentrate more on the larger multifamily side. Not saying there's anything wrong with the single family investing. It was quite good to me when things were rosy. But I think the ability to scale, the ability to partner with people, have that professional management, even how the properties are valued. You've got income approach versus comparable approach. I see so many advantages in working on the commercial real estate side, and I just wish I started in that a lot sooner.
Tell us how then the commercial real estate side works in Canada. I mean, where are the opportunities, and what's the upside there?
Yeah, so very similar market now. So we're speaking in 2019. We've got cap rates have been very compressed. Very similar to what they're at in the United States. The one thing, if we're speaking specifically about multifamily real estate, is you have to be very careful. In the province of Ontario, where Toronto is, you have rent control, and the laws are very pro-tenant. So doing that value add play that a lot of people will do in the U.S., depending on the state, that doesn't really exist here. So for myself, with building up my multifamily portfolio, I'm actually concentrating on Houston, Texas. I love the Houston market. I think there's lots of great key market drivers there. There's a lot of runway left in that market, and there's some really good opportunities. Plus, it's Texas, so you don't pay, you're on the street. There's no rent control. I had to deal with in Ontario. Lots, depending on whether you're looking commercial real estate in Canada or the United States, there's some really good opportunities, even though a lot of people would say we're at the towards the end of this economic cycle. I think you just have to, you look long term, you make sure that the market drivers are there, and as long as you're purchasing a place where you have that value add component, or you have some sort of value strategy, whether it's over the next couple of years or in a rent controlled area, maybe you push it out to the next 7 years. You need to have that strategy in place and know when your exit's going to be. I found one of the biggest mistakes real estate investors have, especially when they're new, is they'll purchase a property without thinking about their exit. So they're only thinking about, yes, I bought a property, but how are you going to profit from it? Are you going to sell in 5 years? If so, what's your game plan to make sure you're going to get the return you need? Or are you going to hold it for 10 years? Well, if so, where do you think this market's going to be in 10 years? Will you be able to exit at that time? Or, it's all hypothetical, but you still need an exit plan when you're purchasing the property, so you can be focused, not get lost along the way.
I want to talk about exit plans and investing in Houston, but I also want to go back to rent control, because you're seeing firsthand where you are, how rent control works. What's your take on rent control? What's the pros and cons of it? Because it's something that the city of New York is looking at, or the state of New York maybe, and you're starting to see that crop up in conversation here in the United States. So tell us your take on it, please.
Yeah, I think, as a politician, rent control is great if I'm trying to target a specific demographic in the population. I might get some extra votes. But what we've seen here in Ontario is you have rent control, and we've experienced a pretty significant boom in real estate values. But rent's always lag behind. So these owners are purchasing these properties at X dollars. They're at, let's say a 3.5 cap. What's the incentive to pump money back into the building, bring it up to standard, when they won't be able to raise the rents? It's almost like you're investing in the building, but you're getting zero return. Your return will come when that tenant vacates and then a new person comes in. So it's a very long process. So if I'm a landlord and I own let's say a 200 unit building, where's my incentive then to keep the building up? I'm better off not, letting the building kind of deteriorate and then just doing a full scale renovation once everybody has to get kicked out because we're doing a huge reno. So I think there always has to be incentive for an investor, for an owner, to get a realistic return on their investment. That's how capitalism works. But rent control removes that, and then now you have a government dictating what a person can earn on their money in a supposedly free market environment. To me, it makes no sense.
So the flip side of that would be people would say, well, they're still building, they're still creating new housing. Obviously, rent control hasn't stopped that.
Well, I would, and with the Toronto example, people are still building, but they're not building rental properties. They're building condos for the resale market. So new construction with rental specific properties, if you look at the numbers, like it's all condos for resale that are being built now, and a lot of developments that were originally scheduled to be rental specific have now gone away, and they're being replaced by condos. So that's what happens. So you think, from the surface, a policymaker might say, oh, that's great, we're seeing strong growth. But when you look at the numbers, like that, the product coming online to the market is not the product the market needs. Developers will always follow the money. If there's no money in developing, then they won't build.
The other argument is affordability. Now, because of rent control, more people can afford to live in their rental properties. Mm-hmm. Are you seeing that? Is that one of the positive sides of rent control?
Well, I think about it this way. Let's say you own a home, and let's say we're in Canada, so you have that balloon payment, and interest rates, spike. Is the bank going to give you a deal because of affordability? We have a huge affordability issue right now, on both sides of the border. The bank's not going to give you a deal just because you're a nice person and they want to make it easy to live. It's the market, and I firmly believe the market has an ability to police itself, and everything will balance out in the end. But what happens is, let's say I'm renting a property that is rent controlled, and let's say it's a 1-bedroom, and now I get married, I have a couple children, and now I have to move. I know now I'm stuck at market value, and my rent payment's gone up maybe $800, $1,000 a month. So that's a sticker shock right off the bat. So I don't think that helps anybody. I'm getting a little worked up here because I hate rent control. Yeah, well, if you can't tell.
Yeah, I can tell, and your answers are great because you're seeing the effects of it firsthand, and that's important because there's a lot of people who think, rent control is a solution to affordable housing and all that. We're saying the same things you are, which is, well, if you want to decrease the value of properties, if you want to see the existing rental properties deteriorate because the landlords don't want to reinvest in that property, if you want to see the lack of housing, less affordable housing, then go down the road of rent control.
Yeah, I think it's a major error. And actually, one of the political parties ran a number of years ago on eliminating rent control, and I was all for it. So, but yeah, if I put myself in a tenant's position, if I'm living in a building, would I want to pay an extra, let's say, $200, $300 a month more, but to have everything working, have a better tenant profile in the building, have everything taken care of, have a safer environment, not have dangerous issues? Or would I rather save $300 but have poor tenant profile, buildings run down, we've got all these problems because the owner's not paying any money? I'd rather pay more. I see a lot of value in that extra money to have a well-maintained product.
That's a scary thing. So that's why you're investing in Houston. Let's talk about that.
Yeah.
How in the world are you investing in Houston when you're just outside of Toronto, Canada?
Yeah. So the internet is amazing. You're able now to, before you'd have to go to all these, go through all the records. Now I can pull up census data. I can pull up, employment growth. I can pull up all the stats from the U.S. Census Bureau and all that stuff from my laptop. So it makes market research very easy. When I decided to get into the larger multifamily space, I looked at a number of markets that I felt had potential, and there's lots of great markets out there. But I felt for just from what I was seeing and the drivers I was looking for in the market, I felt Houston was a very good fit for me. So it's a matter of it's all networking. I fly, you go to Houston, shoot around a golf with a couple brokers. It's all about building the network there. But you've got with the larger multifamily investors, we've got people in Pennsylvania investing in Texas because the advantage is you have on-site staff managing the property. Sure, they'll go visit the property every month or two. You've got boots on the ground there. So the scale allows you to build a portfolio, whereas you're not necessarily like the mom and pop operation where you have to drive down the street every day to check on the house.
So how are you going about it? Are you partnering with people who are already invested or are located down there, or are you kind of doing it yourself and just hiring staff and payroll to take care of the properties?
Yeah. So as of right now, just so I'm clear with all the listeners, I haven't taken down a property yet. I'm in the process. I almost had a 160 unit deal, but that didn't work out. So right now I've got the short list of property management. And with property management, you always want to fit the manager to the property. So you can't just say, I'm going to use this property management company for every property I buy, because every company has their own special niche or niche. So you want to be very cognizant of that. But yeah, it's raising capital both sides of the border. The rules are slightly different, but it's all, at the end of the day, it's accredited investors. So having those investor conversations, saying these are the advantages to multifamily, this is the type of product I'm going to buy, this is my game plan, these are expected returns based on that game plan, and these are the amazing tax advantages you can use to lower the tax you pay and put more money in your pocket. So right now, the foundation's there. I've got the podcast. My second book's coming out later on this year. So everything's rocking and rolling right now. And every day I'm underwriting deals, ready to pull the trigger.
You're basically syndicating. You're looking for some opportunities in the Houston area. You'll be syndicating, bringing in investor money, both Canadian and American, and taking down these deals, and then partnering with the management company it sounds like you've got some management companies that you're looking at to work with.
That's right, and management companies super important. We probably go through a lot of horror stories of bad management, so you always want to make sure you have good management. And the thing with multifamily is it allows you to bring other people into the deal. Because there's enough slices of the pie. I like eating pie, but I'm willing to share the pie as long as it's advantageous to everybody. So let's say I come across a 300 unit deal. That's probably a little bit too big for me to take down on my own. So you bring in another person on the general partner side that shares the same values, and you guys can work the deal together, and there's enough there for everybody. That doesn't really happen on a single family home.
Let's make sure our listeners know how they can get in touch with you. And also, I know you wrote a book. You've got another one coming out. You also host a show.
Sure. So the first book is titled Sell for More. So that's written to educate people on how they can maximize the sale of their property at every stage of the market cycle. So you can find that for the American audience. You can find that on Amazon. That's the best way to find that. My second book coming out. So right now I've done about 150 interviews on my podcast. So I'm taking so what I found was there were similarities between all the people operating at a very high level. So I've taken all those lessons and I've put them into book format, just finishing off the manuscript right now. So that'll be out later on this year. So I'm really excited for that book. I'm very pumped up.
Does it have a title yet?
Not yet. So it's untitled. We'll have to send it to the publisher and the editor, and then they'll figure out all that stuff. But no, it was an amazing experience compiling all, because you talk to 150 successful investors, you learn something with every single interview, and now you're going back through that content. I have a much better appreciation for how good the information through these podcasts really is. You get some really good stuff.
Give us an example. What are some of the top similarities between the high level investors that you talk about?
Yeah, a lot of them have a routine that's ingrained in them. So a lot of people are very early risers, and they'll do the exact same thing every morning. And that really sets them up for the day, and they found that structure helps them confront problems that they'll find. So having that structured morning and structured day, a lot of them really do that. The other thing is mindset. Well, the one thing I've learned is real estate, it's probably 10% actually doing it, and 90% is knowing you can do it and how you think about it. There's taking down $100 million deal is easier than taking down a $10 million deal. And every single person who is operating at a high level, so I've had a number of people running billion-dollar real estate operations, they all say the same thing. So now it's all about simplifying their portfolios. So instead of doing, let's say, 5 $50 million deals, they'll take down like a $300 million deal, and their life's so much easier. So that would be another thing. And then I would say the most important would be their stick-with-itness, how they deal with adversity. Almost all of the ultra-successful people I interviewed, they all hit absolute rock bottom at one point, whether being wiped out in 2008, or maybe a couple of them got wiped out in divorces. They all hit absolute rock bottom where life was basically done, and they all climbed back even stronger than before. So I think because I have a lot of real estate conversations, so many people, as soon as they hit the first speed bump along the road in real estate investing, they say, oh, it's not for me, it's too hard, I can't do it. But you just have to keep driving through it. And the people who do succeed at real estate investing, they don't get hung up on the small problems, because the big problems today are just like a small minor bump on the road in the future. And I think with my own personal experience over the past year and a bit, that's really become a lot more clear. What I thought was the end, a year ago, is only just the beginning now. And I think hitting rock bottom gives you fuel, and it almost gives you a chip on your shoulder that you didn't have before. So it's almost like that drive and determination, and it's like a wind pushing you from behind.
Yeah, it's good to have adversity to fight against, because I always find without that adversity, you just get complacent.
Yeah, but pain is necessary. Whether it's physical pain or emotional pain is necessary. And it sounds kind of funny, but all the ultra successful people I've spoken with, they've all had tremendous pain in their life.
You got to embrace the pain, embrace it. Yeah. Tell us about your TV show, your cable TV show.
Yeah, so it's a cable TV show available in the Greater Toronto area. So it's myself and 2 guests. So we talk about, my podcast is specifically real estate investing. On the TV show, we talk about investing, but we also talk about, selling your home, buying a home, building up a portfolio, financing. So it's more of a mixed bag type of show, but we do have very solid guests on the show, and we have a really good time. So I love doing it.
That's awesome. So how would people get a hold of you, Seth?
Yeah, the best way is to go to sethferguson.org. Don't go to .com. That's an evangelical preacher. So if you want real estate, sethferguson.org. And I've got a free download for people. They can. I put together the top 7 key market drivers I look at when I'm investing in a real estate market. So you can find that there, sethferguson.org.
Awesome. Well, any parting thoughts for our listeners? I know you've been through a lot. Maybe you've hit rock bottom. Hopefully you have at this point, given the story you just told us. But I think you've given a lot of inspiration to our listeners. Is there anything else you'd like to say before we wrap it up?
Yeah, I would just say if you're thinking about investing in real estate and you haven't taken action, take action right now. Too many people come to me and say, hey, I want to get into real estate. Can you help me? And 3 years down the road, they're still doing more research. They're still thinking about it. They still haven't found the right property. Take action now and don't worry about the rest. Just do something about it, and you'll thank yourself, 5 years down the road.
Awesome. Well, Seth, it's been a great conversation. I really appreciate you sharing your story with us. And I know it's painful, but it's good for our listeners to hear that because, everybody goes through that, something similar at some point in their lives. And it's good to hear how you've bounced back and remained positive and successful in the process. So thank you very much. It's been a great conversation.
Yeah, it was my pleasure. Thanks for having me on.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.